Quick disclaimer, these videos are meant for educational purposes only. Anything said or shown in any of these videos are personal opinion and my perspective. Trading carries a high level of risk, so anything done is your responsibility. Hey, how's it going, guys? Welcome back to mentfx, and yes, I'm still wearing the same shirt from the last video because it's the exact same day and same video. I'm just going to wait to release this because something that I wanted to get across was a little bit different. But under this 3-box methodology and the way we specifically teach, and if you have not seen the 3-box methodology video, please make sure to check that out and watch it and understand it. And we have a few bits of content for it. And of course, go and watch the rest of the stuff on my channel because all of it seeps into and lays a core foundation for the rest of this, for the rest of the way we teach, right? But what I'm going to talk about today is understanding how to play between timeframes and how you should be thinking about timeframes in terms of trading. So as a lot of you understand, as I've always spoken about, when you're looking at impulses, pullbacks into those impulses, especially in the form of mitigation or in the form of imbalance fulfillment or inefficiency fulfillment, right? And by the way, for anyone thinking like I'm fucking insane right now, if you're new especially, let me give you a quick laydown of what that means. So the 3-box methodology is ultimately looking for some kind of impulse in the form of a blue box, allowing that impulse to create a new liquidity run, which means you're predicting price to go to this low, having a red demand or supply zone at the top of that zone, looking for price to come into that zone and watching for a confirmation of that zone in relation to the transfer of weak to strong hands, which is oftentimes Wyckoff. So what that means is this right here will occur on every single time frame. Let's take a look at how that might look. So you have a blue box impulse right here. This is actually a trade that I took myself. And this was during Thursday, during the Asian session. You have an impulse right here, which means what? You created a point of invalidation at the very top, and you've created a point of liquidity at the very bottom, which means if we do get into sells, you're going to be targeting the lower point and then potentially much lower. Sorry. I've been drinking too much carbonation, so it's all good. So here's where the interesting part happens. This is where the refinement part happens, right? You're going to have a point or a supply and demand zone that you're going to be looking at to be a seller from, right? But guess what? You're not always going to get the pullback or the mitigation that you're specifically looking for, right? Because what's an inefficiency? Well, an inefficiency is a amount of space between the wick and another wick, right? So this is an inefficiency, and we look as smart money traders or as some retail traders, but you're taught the wrong way. So either way, you're looking at inefficiency and you're looking for that to be fulfilled, right? This is what clean candles look like, clean price action or inefficient price action as per smart money standards. You're looking for that to be fulfilled because there are orders that have been left unmitigated. That is why usually price looks to come back and fulfill those areas, especially if you have an overall intent that is still being held down by an overall protected high, something taught on my channel as well, and a liquidity low, right? So then as long as neither of these are invalidated and it stays in here, you're looking for either the protected high to fail as this topside liquidity gets taken, and then we might start a new bullish bias, or to have that liquidity delivered still to the downside and continue that bearish bias, accounting for more lay on orders into the future and the continuations downwards, right? Now, what's interesting about this is you'll notice that I actually didn't have a mitigation come back up to this specific supply zone, hit it, and then go short. How was I able to position myself in this? Well, this is where the importance of understanding timeframes for the purpose of seeing price comes into handy, right? So a lot of the education around timeframes is very detrimental to people's development, right? I'm sure, and I've been through this too, that's why I'm kind of sure of it, you've been taught to think of a system in a one time frame kind of basis. It's like the best RSI settings for a 5-minute chart, the best MACD crossover for a 10-15 minute chart, the best 1-hour candlestick indicator with the perfect RSI support and resistance lines based on the daily that you can enter buy now. You know, it's all things that are based around understanding one time frame, keying into that specific time frame, and just forcing shit on that time frame, right? That is not the way you want to think about time frames and price. What I've always said and what I've always taught is that time frames exist for the purpose of seeing the way orders were catapulted into and taken out of the market and how they were delivered inefficiently or efficiently during a specific time, right? And at the same time, allowing you to see the volume in a supply or demand zone that was formed to understand the most probabilistic area it will mitigate before going short or long. So what do I mean by that? Well, if you have an impulse, just like that, and you have a demand zone, just like that, I'm sure a lot of you have experienced this, where price comes back, right? You know, maybe plays around, whatever, comes in, just misses it by a tiny bit and goes, right? So it misses it and never touches it, and then goes. And you're sitting there going, that's it, FOMO, and you start all-inning your shit, and then you lose your account, right? All good. Or you've experienced this, where you've had a zone, price comes down, right? Maybe gives it a little touch off it, comes a little bit deeper, right? Accumulates and then goes, right? Weak to strong hand transfer, and then it goes. Well, that's the same thing happening. Now, why does this happen? Well, that's because you're singling in on a specific time frame, forcing one zone or another zone without allowing a higher time frame delivery of price to determine where the most probabilistic and likely mitigation is going to happen. What does that mean? That's a lot of words, but what does that mean? Well, that means that, for instance, you have this impulse right here, right? This is the impulse, and I'm not going to use the 3-box strategy here because I just don't want to draw all the boxes because I can see it myself. I got used to seeing it. You have this impulse right here that breaks this structure clearly, right? Which means we've created that point of invalidation at the top. This is our protected high. This is something that we call a protected high in the mentorship, and we've taught for a while, right? So unless price breaks back above this, that protected high should hold under our assessment of price action. So that's your protected high that should hold price down, because what it means is whatever buyers, right, took out sellers here. So again, whatever strong hands took out weak hands from previous zones, they are going to want to hold price below this point if they want to continue a bearish delivery in price to the downside, right? And if they want to continue that bearish delivery, they're going to hold it under the point where they have most orders trapped and most of their liquidity, their own orders, reside, right? With the occasional move back into the zones to mitigate whatever orders existed there in the form of what? Inefficiency and imbalance to continue going in a given direction, okay? So if that's our protected high, then we also understand that this is our non-protected low, right? A low that should have its liquidity ran. And we can draw it out like this if we want, right? It's a cluster of orders, right? You can see this as anything you want on an order flow or a booklet report or for liquidity providers books. This is going to look like a colored little area that might look a little bit something like this. So if you've worked in a prop firm, you know how this looks, right? A lot of prop firms trade this way. They'll be seeing this on a chart basically, right? With something like this around it. So they'll be seeing basically this, right? So they'll be seeing a little bit something like this on their order booklets, right? Because this is how prop firms trade, literally. They'll be seeing something like this. So what they're aware of without having to look at any candlestick charts, right? So what a lot of here we go. What a lot of prop firms see is something like this, right? And they know that there's a lot of liquidity or orders or volume residing in these areas. And what does that usually tend to add up to or correlate with? A number of lows or a support resistance level that people would use in a retail setting. Because why? People are interested in being buyers or sellers at that point, right? Buyers for the people that want to see the retraces from them, or sellers for the people that want to see it break and continue going short. That's what they're looking for there. So that is how we determine, or why we call the completion of an impulse or the bottom of a blue impulsive box a liquidity point that should be the next run on liquidity, because that should stand as the next order flow run if we are to remain the overall bearish bias in the market. So why is it that I'm using this zone and not this zone? Well, this is where the volume of candles comes in and where timeframes become a very important aspect to your trading. Look at this candle and think about what this candle represents. This candle represents a very small bit of orders being passed in and out of this market right here before a huge amount of orders came down, right? And if you really want to find the last up candle is this large one right here, right? So this is your last up candle, right? And even if you use that, notice it didn't do anything, right? It didn't come to it, right? So even if you refine this at that point, it doesn't matter. This is where timeframes come in handy. You need to recognize that you're not a time frame based trader, you're an order flow based trader. And the way you view order flow is going to be defined by how you switch and allow other timeframes to show you that delivery of price. So even though we understand that from this wick to this wick is inefficient price action, and there's a good chance that price is going to come and fulfill that inefficiency, I'm sure a lot of you have also seen that when you have an inefficiency like this, it comes to maybe 50% of it, something like this, okay? And then goes short. And you're like, oh, I should start trading my imbalances. This never works. First of all, don't trade just imbalances, because imbalances are everywhere and it's going to confuse you over enough time, and there's actually going to be less opportunity because there's so much opportunity. You're going to be very confused. But two, the reason it happens is because oftentimes a 50% of an imbalance or an overall area has a larger time frame cluster of orders that has created a supply or demand zone that you're actually tapping into. What does that mean? And why is it that I was able to catch this short from this POI's confirmation? So again, this was a Wyckoff short. I'm not going to zoom in on this. I have no need to do that. And I looked to take it down, got my first partials. So that was a really nice partial. And I looked to keep targeting lower, but I got stopped at break even when it came back up. And that's fine. And then order flow shifted. So that's it. That happens. And I was done for my trading day. But let's talk about why it is that, how you can use these timeframes now, right? So where is that volume of orders? Yes, it's in here, but let's play around with timeframes. Let's go to a 2-minute and view the order flow delivery, right? So let's think about this order flow delivery here for a second. You have this up move, this down move. You have this huge wick that comes to mitigate whatever was up here, right? You have it come down, you have it come mitigate whatever's in here, and then you have it drop off. Notice this wick here, right here. That in itself is also an inefficiency, right? So even though there's an inefficiency from here to here, the real inefficiency is usually from here to there, right? Why? And I'm going to show you in a second. And notice how that's where it goes. Let's look at a 2-minute chart for a second. What do you see? A completely different story. You see a completely different story about how institutions, or the composite man, or Richard Wyckoff in his grave, was able to enter and take out weak to strong hands and then leave behind the real inefficiency. You have a reach up and a huge collapse back down. And as we collapse back down, you can see all the volume in this candle. A lot of selling pressure into those buys in this candle itself. And after that, a huge drop off that creates that inefficiency we just drew from that 1-minute prior candle to that low. And now this inefficiency itself becomes a higher time frame defined inefficiency between one wick to another wick, thereby giving us an area we want to mitigate, and moves this supply zone that has now been mitigated to the last unmitigated candle, which becomes what? This candle right here. And what point was I looking to confirm for my 3-box setup? Well, impulse, S&D, confirmation. 1, 2, 3. Structure, POI, story, whatever people want to call it, AOI, it doesn't matter. 2, S&D, whatever other words exist for supply and demand, right, in the form of this specific way of looking at mitigation. 3, confirmation. However it is you want to view that. Fractal structure, fractal setups, pin bars, I don't care. Wyckoff, whatever it is you want to view it as. The reason I was able to define this entry and find a nice entry from this point without missing it as a result of, for instance, without missing it because I would have used, let's say, this 1-minute little zone right, where the fuck did it go? Yeah. Without using this 1-minute, okay, let's replay back to here so I can stay on this general area. Without using this 1-minute zone in here, why was it that I was able to catch this? Because I allowed myself to look between timeframes to understand how price delivered in a certain area, how mitigations were made on behalf of whoever is on the other end that has the means to control an overall market and mitigate their own positions, right? And as it's created, how and which inefficiency left behind gave us the best probabilistic idea that it was going to be traded back into, mitigated to that specific point, and then go short. And that's exactly what that is right there. The inability for this to come up into here didn't come because this was the wrong zone, right? It came because the main inefficiency existed from here to here, and the main bulk of volume in our area existed from where? From this last potential up move. So there's even an up move in here. That last up move in there to go short, right? And maybe you can even play around with it like a 3-minute. Let's see. Yeah, so even on a 3-minute, you would have been able to catch this. Why? Well, you have this impulse, and clearly, after this up move, the last down move is this one right here. Boom, right? So you could even use this zone here. Either way, just stepping a step back and zooming out or looking at a higher time frame to understand how price delivered in an area, which again comes back to our main point of we don't look at timeframes for the purpose of little timeframes, right? We look at timeframes for the purpose of seeing how price moved during a specific time. Two very similar but completely different things that can redefine the way you view trading, right? Which inefficiency do I use, the higher time frame or lower time frame? Well, you use a combination of both. You understand how the confluence of a lower time frame inefficiency, confluence with a higher time frame inefficiency, and how a higher time frame supply or demand zone confluence with an overall lower time frame inefficiency and overall lower time frame zones. I'm not going to get into it too far right now because there's a lot behind it, and a lot of it is talked about, worked with, and discussed in the private mentorship. So if you want a chance, join that with the link down below. Or if you've perfected your system and this has given you the light, check out mentfunding.com at the top right here. Look to get funded with one of the best brokers in the world. Not brokers, but one of the best funds in the world. And I only have a few symbols open here, but we have a shit ton of symbols available. And you can see how great the spreads usually are. So your USD is still like 0.0. Either way, thank you so much for watching, guys. This is how I think about timeframes and orders, and how I don't just keep myself or limit myself to one specific time frame, and why I'm able to continuously be flexible and play around with certain areas. And this is how I determine which inefficiency or which zone is the best zone or inefficiency to use. All right, thank you so much, guys. I appreciate you all more than you can imagine. Thank you so much for 50K. You guys are fucking insane, and I hope you're always doing the best. Yeah, have a great week, guys. Great week, great month, and a great year. And I'll see you guys soon. Also, follow me on mentfunding on Instagram. And stay updated. There's going to be a lot of cool stuff coming out soon, and I can't wait to share it with you guys. So, peace.